afternoon, everyone. Thank you so much for joining another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And on today's webcast, we will provide you with a brief macro overview. And of course, at the tail end of the conversation, be pleased to address your questions. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Q&A or the chat via Zoom. And with that, I turn the conversation over to our one and only David Burrows, our Chief Investment Strategist and President at Barometer. Good afternoon, David.
Hi, Pamela. How are you?
Great, thank you. Excited for your webcast.
Well, listen, glad everybody can join today. Lots going on. We are into the meat of earnings season. And so that has implications. It means that companies are quiet during this period. They're not talking about what's going on business-wise. Companies are not in buying shares. The largest buyer in the market is corporations buying their own shares in general. And so they are largely quiet as we go through this period until they report their earnings. So it takes a significant buyer out of the market. We have a really important Fed meeting coming up in May, which is widely expected to be one more 25 basis point hike. And we got lots of cross currents. You know, numbers have been taken down going into the earnings. So expectations are relatively low. We got some big ones coming tonight, including Microsoft. We have just very muted positioning, quite defensive investors and negative sentiment. There's some question as to whether bad news ultimately is good news because it helps the Fed get to the point where they're comfortable stopping with the rate hike cycle or pausing. And of course, we're going to get data points from all areas of the market as we go through the earnings period for the market to chew on day by day. So I always say that the market is most likely to behave the way that it is set up coming into news. And we've talked about the fact that breadth has been reasonable in the market and improving. So let's just go from the top and take a look at what we're seeing going on from a market perspective. So just to start with, we continue to believe we're in a structural bull market in stocks. We've stayed above this rising 200-week moving average ever since 2013. We've come down and tested it a couple of times. We made a low in October, we made higher lows in December and March, and we're sitting up here more or less in the top end of the range. So sloppy day today, but it's always great to put things in perspective by taking a longer term view. We get bear markets and corrections during secular bull markets. This has been going on 122 months. We had a correction in 14-15. We had a bear market. It was quick in 2018. We had a quick bear market in 2020. And we've been going 16 months in this most recent one. Not too dissimilar from what happened in the late 1980s, 1989, 90, heading into the 1990-91 recession. And of course, once we got into recession, the market started to rally because it looks forward. So my view is we continue to be in a structural bull market in stocks. From a bond perspective, we've looked at this picture virtually every webcast. Rates have been falling since 1981. We made I believe, a generational bottom in 2020. And rates have been rising since then, much like they did after the period late 1930s, late 1940s. And we reversed this long downtrend in rates that's been in place virtually my whole investment career. And rates have moved higher since March of 2020, and they've been in this range, kind of 340 in the low end and 425 in the high end over the last 6-7 months. And so that's a significant reversal or regime change. We believe now we are in a rising rate environment and likely to be for several years. Probably means inflation is a little bit sticky, but yet comes and goes. And it probably means different types of securities do well than the ones that have done well during the period of falling rates. When we look at the TLT, the US long bond ETF, falling in price since 2020, at the worst point down 48%. It bounced a little off the lows in October, but basically has chopped its way sideways and remains below all of the long-term moving averages. So at this point, really, even though there's been a mountain of bond buying taking place, it has not been a very fruitful exercise. certainly been treading water. And in fact, the S&P has outperformed the bond market over the last 18 months. So when we look at commodities, another big asset class, made a generational bottom in 2020 after declining from 2008 and a series of lower lows and lower highs, then working its way higher and consolidated. Certainly following that big move up, we got well extended away from the long-term moving averages, but recently in the last month came out of this range to the upside. So when a company like UPS reports, like they did last night, and talked about lower traffic in their ground transportation business, it has an impact on all economically sensitive securities. Commodity prices pulled back a little bit here today, but very clearly we've come out of this consolidation. When we look at gold versus the S&P, this is one that I like to look at because it highlights regime changes. Gold started to outperform the S&P in the early 2000s and then outperformed for 11 years. And so I do think that it's relevant that gold has recently started to outperform the S&P. It's an unloved asset. Generally, the buyers who buy gold are speculating, but it's interesting. In this case, it's been central banks. So this is central bank buying back to 1950. And when it starts, it tends to go on for a while. And we've seen a big pickup this past year in central bank buying. That may have to do with Russia and China and Brazil and Iran working at perhaps getting off such a strong US dollar bias for their trade. And it may be that they're putting reserves in gold as opposed to putting them in US Treasury bonds. We know that the Japanese recently announced that they plan to be big sellers of US Treasuries. So gold is being a beneficiary of being a safe haven for those assets. We look at the US dollar, it's the same picture it's been over the last while. US dollar rallied all the way through the bear market leading up to October of this past year when it started to back off, and it broke all of the various support levels, moving averages and so on until February. Stock market pulled back through the month of February and US dollar got a safe haven bid, but has been selling off since. And until that changes, my view is we are in a more risk-on environment than we are in a risk-off environment. Certainly, certain types of assets, including commodities, benefit from a weaker US dollar and certain risk assets as well. Let's talk about data. We're not going to focus too much on economic data this week because really what matters is earnings. So we've got 123 companies having reported as of this morning out of 500 in the S&P 500. Now, keep in mind that this is off of reduced estimates. Analysts have been taking their numbers down. Sales surprise on average has come in a little over 2% above expectation on revenues, and earnings have come in about 6.5% ahead of estimates on the earnings front. In fact, 77% of companies so far have beaten the estimates. So from that perspective, the earnings period has not been a negative surprise. But again, I want to highlight that numbers had been taken down coming into this period. We've seen big earnings beats in industrials, big earnings beats in materials. We've also seen some earnings beats in consumer products companies. So those have been the big beneficiaries. And tech has been the one that has come in underwhelming in general, albeit some of the large ones have done quite well. We'll see how Microsoft does today after the close. So we care about the economic data. We care about the earnings data, but our job is to understand the message of the market. I think that our job really is to always work at trying to identify those areas of the market that are seeing some tailwind, where we're seeing valuations improve, multiples expand. We call that market leadership. That could be specific sectors or themes or geographic regions. We don't need to be everywhere. We want to find those assets that are being revalued. We watch every day in the tools that we have and the process that we follow to identify new leadership as it emerges and old leadership as it recedes so we can transition our holdings in a timely way. And in the absence of leadership, we have absolutely no problem sitting with cash or being out of big parts of the market. So it is a very tactical approach. Our job is not to be everywhere, it's to pick our spots. And at the risk of being repetitive, because I really want people always to understand what we're doing, we believe 80% of return comes from getting to the right asset class and the right sectors within those asset classes. In other words, get to the right neighborhood. And 20% of return comes from finding the specific securities that for whatever reason are doing better than the rest and can be revalued relative to their peers. We address sector and asset class by our top-down work. My focus is macro, trying to take all of the various geographic regions or neighborhoods we could focus in, asset classes, sectors, themes, and try to identify those that have expanding breadth, where over time more and more companies or securities are performing well. We know that when money is getting put to work, it will spread to more and more securities over time as the tide comes in. And our job is to find those areas that are beneficiaries of new flows coming into the market. Our bottom-up work looks at the very broad universe of securities, trying to identify those that, as I characterize, are good getting better, where fundamentally their income statement and balance sheet data is solid and not just good, but improving, where we see the second derivative acceleration in the progression of the numbers. So if we can find improving fundamentals along with improving technical characteristics, well, that's where our portfolio should live. So that's a farm team, things that we'd like to own and where they fall into groups that meet our top-down tests. Well, that's where our portfolio lives. Good securities in areas of the market that are beneficiaries of new flows coming in. The third piece of the strategy, which is as important as all of the rest, is having a very, very disciplined selling process. Because I can tell you, if we put on 20 positions, or try to buy things that are good getting better, 2 or 3 will be way better than we expected. They're getting better faster than we thought. 7 or 8 will be pretty good, and a bunch won't work. So our success as managers is tied to our ability to hold the ones that work as long as they continue to improve. But on the ones that disappoint us off the bat, or where something changes and price begins to break down, to be prepared to go to the sidelines using our stop losses. We don't ever want to see little mistakes turn into big ones. From a top-down perspective, we're always looking for areas of the market that are showing expanding breadth. So this is really important in the environment that we're in now. When you've been in a difficult market, at some point during the decline, a few securities or sectors or themes will start to behave better than the market. So very often the next cycle's leadership is driven by the sectors that turn up earlier than the market does, and then continue to improve. We want to find parts of the market where the percentage of securities performing well is expanding. Now, through the course of an advance over time, more and more securities should participate as the market buying broadens. There's no bear market in history that took place while breadth was expanding. Now, at some point, late in an advance, for some reason, there's a problem or a concern. Certain things will start to roll over early. Now, we all tend to focus on the leading securities in the market, as it's been over the last few years, companies like Microsoft and Apple and NVIDIA. But when the weaklings underneath the surface start to roll over, we want to know, because it means that the buying is getting very focused in a few securities, and under the surface, there's weakness. That tells us we got to be more cautious. We got to tighten up our stop losses, reduce our tolerance for risk, and stop putting any new positions on so long as breadth is deteriorating. When our breadth models show deteriorating breadth, we just get very, very cautious. And so we run these models daily across 300 universes of securities to recognize change, new leadership as it starts to emerge, and old leadership as it starts to roll over, so that we can make sure that portfolio contents that we have for our client accounts are always relevant in the current market. So let's talk about that a little bit. As of today, the vast majority of our breadth indicators continue to be positive. Now, I know it was a sloppy day in the market today, and the market didn't like UPS's numbers, and it didn't like First Republic's deposit numbers, the California bank. But I can tell you over the past number of weeks, the percentage of stocks in the NYSE that are in uptrends has been expanding. And in fact, as of this morning, we were at a new high from a bullish percent standpoint since the market started rallying in October. When we look at the percent of stocks globally that are performing well, it's slowly been expanding. Now, that doesn't mean it can't change. But generally, when you get bad news and the breadth data or the market internals are healthy, generally we can absorb that news pretty well. Now, from a shorter term perspective, in Canada, the US, and globally, the percent of stocks trading above their 50-day moving average also has been very resilient. That's a shorter term measure of trend. But all three have been improving. Percent of stocks with positive weekly price momentum or upward trajectory. This week didn't move much, but it didn't move lower. The percent of stocks making new highs versus the percent of stocks making new lows has been expanding. And the percent of stocks trading above the 150-day or 30-week moving average also has been improving. So our rules, should three of these short-term indicators turn down, we will get more defensive. We will raise some cash. We will reduce our exposure. If the bullish percent reading reverses down, it takes a 6% reversal in direction, we will raise some cash. We will stop putting any new positions on. We will follow our stop losses. But at this point, this data is very supportive of this market. Moving on, there's the S&P 500. This has been a long drawn out process, started in the end of December 21, and the market moved down in a series of steps. We made a low in June. Some of the leading groups actually bottomed in June, and it did not make a lower low in October. That was important to see. The broad market made its low in October, just above the rising 200-week moving average. Since then, made a higher low in December, a higher low in March, and currently sitting above basically all moving averages, 21-day, 50-day, 75-day, 150-day, 200-day moving average. And not only that, but the long-term moving averages, after going down all the way through this bear market, have started to curl higher. That's the 200-day and the 150-day moving average. So this is not a bad picture. And can it pull back a little bit more over the next few days in earnings? Of course it can. But it also can go the other way. And breadth is supportive of the idea that the market made a low in October. Now, later on, I've got a chart that looks at all of the occasions the market made an important low after a significant decline and where we were 6 months later. And in all occasions other than 2001, if you got 6 months out from the market low, the bottom was in. So that's in many, many occasions. Now, it's not to say that this has to be the same as every other cycle, but the fact is there's a lot of evidence that highlights the fact we probably have made the bear market bottom back in October. Let's talk leadership for a moment. As of the 17th, we showed that sector work has been moving to the right. Percentage of stocks in uptrends by sector has been going from narrow breadth to better breadth. Last week, 40.73% of the companies in the market, the average sector had 40.73% of stocks in uptrends. As we sit today, it's 40.89. It's a bit of a sloppy week, but no deterioration in breadth. In fact, some of the groups that have been weak, like biotech, which had been one of the weakest, reversed into a column of exits, which means percent of stocks in uptrends started to improve. Now, a couple of things that are relevant. Semiconductors, which is an important group, went to small letters, which means breadth contracted over the course of the week. It was the same for computers, and it was the same for two groups within financial savings and loans, which is regional banks and the large banks. These are things to watch. Now, it doesn't mean everything sells off. It means the weaklings are getting weaker. So we want to be really critical of holdings within those groups. But you can see the vast majority of sectors in capital letters, meaning breadth is expanding. And we've been moving to the right, meaning that the underlying condition in the market is improving. So the obvious weakest part of the market over the last while have been the regional banks. And today, the regional banks index made a new low. So clearly this is a group we are not focused in. Regional banks have problems, many of them, with their deposit bases, because as rates have gone higher, it makes more sense for people to take money from deposits and put them in a money market fund. First Republic had a much larger contraction in their deposits than was expected. And as a result, the stock was down 30% today. Now, the capital markets banks, things like JP Morgan and Morgan Stanley, have been performing much, much better. It's a very different picture, making a series of higher lows. In fact, made a low in July and made a low around the same level in October, and higher low in December, higher low in March, sitting at and around the rising moving averages. Now, we put this up over the last couple of weeks because the two important bank holdings that we have are JP Morgan and Royal. JP Morgan versus the large banks continues its outperformance. And in fact, it's the same story for Royal versus the large banks ETF. This is always about high grading, trying to find good getting better. Those that are the best quality, that are behaving the best technically. And when there's trouble, often they can skate through much better than others. Now, technology. Technology become a bigger part in the portfolio since December, where we had none. We went through the bear market, basically void of tech. There's an ETF, the XLK. XLK is made up on a market cap weighted basis, with the largest tech companies being most important. So you can see a low in September, a higher low in October, a higher low in December, January, a higher low in March. Relative strength has been rising versus the S&P, pulled back a little bit. But it's really interesting when you look at this makeup versus, say, the QQQ, this is outperformed. And that has to do with the relative size of some of the biggest holdings. If we were to look at the top 20 stocks in the S&P 500, a lot of them, the biggest tech companies, they have generated virtually all of the return in the market for the year so far. When we look at our key holdings, these are all companies in our top 15 holdings. NVIDIA, acting better than 98% of companies in the S&P over the last 12 months, acting much, much better than the NASDAQ. Oracle, better than 91%. Microsoft, better than 86%. And Apple, better than 86%. So you may know more than I do because I haven't seen the Microsoft numbers yet. We'll be interested to see. There is some slowing in their cloud-based business, but we think the opportunity for these companies, a lot of them in the AI world, are things that can really benefit. Meta, still not tech, but communications, but still in that very large tech group, again, better than 96%. So this is our tech exposure. And these companies continue to act well. We are extended away from the moving averages. They can certainly pull back a bit. And we have about a half weight technology versus the S&P tech weight. Let's move on. Industrials, made a low in June, made a higher low in October, higher low in December, higher low in March. That meets the test. Bottomed early, relatively outperformed over the period. We talked a lot about the fact that we're focused on aerospace and defense, and that's acted better. The moving averages are moving smartly higher. We're trading above virtually all of the major moving averages. And we talked last week about some of the machinery companies that are focused on helping the electric grid bulk up in the green energy transition and reshoring. So this is an important area, we think. One of the interesting facts is that when we look at manufacturing jobs in the US, actually they're growing very sharply. So this may be contributing to the employment picture. We know that there's a lot of re-onshoring taking place as companies try to make their supply chains more resilient and take away reliance on China. And we think that this is going to go on for some time, and this is going to be really beneficial to the industrial companies. Moving to the consumer for a moment, I thought this was relevant to put up today. Lennar Holdings, the second largest holding within this ETF, reported its earnings last night. and came in well ahead of expectation. So the ITB is one of only 4 ETFs today of 6,000 that made a relative strength new high versus the S&P, now trading better than 93% of all the companies in the S&P. And this doesn't make sense if you think we're headed into a real tough recession. But Lennar certainly has been executing well, and the Home Builders ETF is performing really well relative to the group, and Pulte Homes making all-time highs today. Moving on, energy. We talked last week about how energy had traded up and out of this consolidation wedge. We've sort of skirted along the top here over the course of the past week. We think this is really important because we've come out of a bear market that goes all the way back to 2014. And during that period, the energy index went down 90%. We do think that even though prices have been suppressed by the fact that they've been selling energy out of the Strategic Petroleum Reserve in the US, they're getting to a point where they're going to have to stop. And it's hard to imagine that prices can stay where they are if you start taking that supply out of the market. When we look at the XLE, which is the Energy Producers ETF, again, the characteristic, it made an earlier bottom than the market, a higher low in October, a higher low in March. And again, we're trading above all the long-term moving averages. So I think that this is really relevant. Materials has the same look, certainly pulled back a little over the last 2 or 3 days, but we want to keep some of these facts in mind. This is inventories for base metals and the number of days of supply currently in the market. So you can see we are right now at 2.7 days of supply, and that's been falling sharply over the last number of years. The last time we got to a tight market like this was in the late 1980s. And at that point, from 1988 to 1990, zinc prices went up 230%. Copper prices were up 175%, and nickel prices were up almost 700%. Now, in the case of 1990-91, that was when Russia blew up the Soviet Union, and there was a ton of supply came onto the market. We don't think that's going to happen anytime soon. So with inventories sitting at such low levels, we think that pricing ultimately can really firm up with any kind of improvement in the economy. Now, clearly there are hedge funds betting against the economy because they look at the Fed cycle and say, well, surely we'll get a recession. But remember, we're a month away from potentially a pause in the Fed cycle, and we think that can take a lot of pressure off some of these commodity prices. These commodities are going to be really, really important when we think about some of the transition that we need to do to green energy. Aluminum, copper, iron ore, all big inputs into moving to green technologies, and these are not the only ones. So copper miners, when we look at the group, we're in a bear market from 2008 through 2022. And here we are moving higher since market bottomed in October. And we think that this is a very beginning of a move and something that can go on for a long time. Just to revisit a comment that we made last week, because somebody asked me what I meant by this, I want to explain it again. Over time, different groups of stocks lead for a period of years until they become broadly owned and expensive. And we know that in 1991, ExxonMobil was the biggest company in the S&P 500. And through the course of the decade of the 90s, we know technology did particularly well, and ultimately Microsoft wound up by far the biggest company. Now, from 2000, tech went into a bear market. And over a period of the next number of years, emerging markets did well. China built out a lot of infrastructure. Resources had a good run into the late part of the decade. And once again, ExxonMobil became the biggest company in the S&P. So we know that, again, from 2009 on, tech had a very, very good run, and Apple is a really important company today. And I'm not taking anything away from it as a quality company. We own it. It's a great holding. But I will say that it is likely, again, that a very large resource company will once again wind up as the largest company in the S&P some number of years down the road. And the only way for that to happen is really significant outperformance over a period of years. Now there's the ExxonMobil chart back to 2008. You can see it's been in a bear market for 14 years. It broke out in 2022, and these are monthly bars, has just started to work its way higher. So when I talk about wanting to take advantage of what is likely going to be a structural, secular, multi-year bull market in commodity producers and energy producers, the prize isn't a small one, right? And we have to be there to do it. But by nature, these groups have to be unpopular and under-owned to set up that opportunity. And you can understand why energy would be unpopular. It fell 90% from 2014 to 2020 and only just making new highs today. So we think that there's a long run in front of us. We'll have to wait and see if that in fact plays out. So from a positioning standpoint, not a ton has changed this week. We continue to have about 10% in large, high quality banks and about 10% in insurance companies. We have about 14% in tech, which is an underweight relative to the weight in the S&P. But we have, I think, the most important companies. Our industrials weight is a significant overweight from the S&P. And this is a combination of defense stocks like Raytheon and Lockheed Martin, who both beat the estimates handily, but also companies that sell into the machinery and the reshoring part of the market. Energy is a significant overweight. You can see it's only 4.6% in the S&P. In fact, if you went back 15 months ago, it was only 2.5% of the S&P. And my guess is it is going to grow in importance as time goes by. Energy was one of the only groups that was positive last year. Materials, we have a 10% weight versus 7.7 a month ago and versus 2.6 in the S&P, again, positioning for a secular bull market. From a consumer perspective, we have an underweight position, but really our only weight here is in the home building and home construction area. Communication services, healthcare, staples, utilities, real estate, all trade a lot like the bond market. They're all more defensive in nature. They have in general underperformed over the course of the last 12 months. And we don't yet see any indication that we should be stepping in here because in fact, many of them are more expensive than they've been in years. This, I think, is the most crowded part of the market, along with cash and money that's been piling its way into bonds. Let's look outside the US for a minute. We've highlighted how when after a 12-month period, global stocks outperformed US stocks, it tended in blue to go on for several years. Well, it's been working since September. This is the Euro Stoxx 50 relative strength versus the S&P. Mexico, good relative strength versus the S&P, acting much better than the S&P. The Japan ETF, now this is in Japanese yen, back to dollars. If you look at the currency hedged, it's actually been a little bit better. But in both cases, we can see rising relative strength versus the S&P 500 and very constructive price patterns. And then, excuse me, as alternative assets, again, the cryptocurrencies all put in lows in June and have been putting in higher lows since then. Certainly pulled back to the 50-day moving average this week, but look very constructive. And you can see how the moving averages are all curling higher here. We think quite interesting. So we're going to watch all of the earnings reports as they come. And we're going to watch for signs that they are having an impact on the market negatively. When we look at volatility today, is up a little bit, but we're working off very extreme lows and nowhere near where we were when the market was in difficulty earlier in the year. This is the level of volatility in March of 2020. It's a very different picture today. Volatility has slowly been coming out. We know that the market has had a tendency 6 months out from major important lows, which September, October was in the most recent case. that once you get beyond 6 months, the numbers start to look really good. 1 year out, even better. We talked about the fact when the first quarter is strong, in every case since 1954, the rest of the year finished strong. And we talked about the fact that when the Fed is done its rate hikes, the tendency has been for the market to have seen its lows. Well, we're 1 month away from what is most likely the last hike. 2000 is the exception. So we think we're still in a bull market. But we know that investors in general are really, really cautious. We know that 95% of JP Morgan clients expect the market to be lower by year end. We know that investors have been pushing their money into money market funds. We know that the flows between stocks and bonds have been almost entirely bonds so far in the year. We know that money market funds are sitting at over $5 trillion in balances. We know that margin debt, the change in margin debt, is more significant than any period going back to 2000. We know that hedge funds are aggressively short S&P 500 futures. And anytime they got this short, it was time to be a buyer. And we know that the number of managers who are overweight equities versus bonds is as bad as it's been since the financial crisis 2008 and 2009. So it's not to say there can't be an outlier, but this is when the market made a low and then didn't make another low within 6 months. Again, all of the cases were positive other than 2001. So should things get difficult, should things get tougher, we are very prepared to play defense. In 2008, when the market rolled over from a breadth perspective, it was before the index rolled over. We went to 26% cash in the first month, 34% cash, 46% cash over 3 months. And when we got to the worst part of the bear market, October, November of 2008, our strategies did pretty well. But we got to have a discipline and we've got to follow process. All I can say is right now, the condition of the market is nothing like those other difficult periods. And if it were to get more difficult, we'll get more defensive. But the opportunity over the next 2 to 3 years is that markets work their way higher after corrections in bear markets. And we want to make sure we can take advantage of it. So with that, Pamela, if there's any questions, certainly happy to answer them.
Of course. Thanks so much, David. One question here from our very valued viewer, Stephen from Toronto. He was wondering about the US debt ceiling issue and how the team plans to manage around that.
Yeah. So look, when you think about the debt ceiling, first of all, the US is never going to default. Right? They might threaten and play brinksmanship, but they are not going to default. So the thing that would get hurt the most if they did default would be treasury bonds, because that's the obligation they have to pay, treasury bonds and T-bills. They're not going to default on those, but we don't own very many anyway. Of course, it could have an impact on employment because you could wind up having a bunch of people get put on furlough because there's no money to pay them. And that would certainly have an impact in certain geographic regions more than others. But I think to bet on something that is really unlikely to happen doesn't make a lot of sense. So my guess is the market will chop around a bit as we go through that sausage making process to come to an agreement. But so long as the breadth models that we track remain positive, it means that internally the strength in the market is there to handle bad news. Should that start to change, we'll change our positioning, but we'll just follow our process step by step and use our stops as required.
Thanks so much, David. The next question comes from Lawrence. His question is, do you still keep buying tech with the companies quite above their MA, or do you wait for a dip here?
Yeah, so that's a great question. And, I put up earlier on how bullish percent for semiconductors and bullish percent for software and bullish percent for computers has turned down. The NASDAQ 100 breadth model is not positive either. So we have about a half weight. We have stop losses on all of our current positions. We would not be a buyer right now of additional tech weight. So there are some important names to own that we do own currently, but that's not where I would be looking to add new money. I do think what is most likely is that you're going to see other parts of the market outperform as we move forward. I think a lot of money's piled into large cap tech as a place to hide because the earnings are more predictable. But you're right, they're expensive. They're well above the moving averages. They can certainly pull back. I said that earlier in the presentation. And I think there's probably better places to look for new money to get put to work.
Thanks so much, Dave. The next question comes from Steve. He wants to know if you think ESG factors affect the future performance of oil companies, even in a higher oil price environment.
Well, certainly we've been through a long period where ESG, did take people out of resources. I think it's actually counterintuitive because ESG requirements make it more onerous to start new major projects. This is a big issue for the mining industry. We're going to need probably 3 times as much copper production as we're getting today globally if we're going to make a complete transition to green energy. And new copper mines are held up by the fact that they need to build in ESG into the way that they go through their operations. So I think that given the short supply, both in energy and in materials, ESG is probably going to make that short supply worse. And as a result, prices probably ultimately move higher because of that. Remember, it takes years to put a copper mine into production. And with the requirements today, it makes it more onerous, and you need higher prices to make it worthwhile to go and try and put one of those into production. So I think it's a factor, and certainly has been a factor in capital spending in those companies over the last number of years. As it stands right now, energy companies in general are choosing to pay down debt, buy back shares, and in some cases raise dividends as opposed to putting more drills in the ground.
That's great. Thanks so much, Dave. Well, that concludes the questions we've received this afternoon. So as always, I'll leave you with the final word, and thanks so much.
Great. Well, listen, we're along on this ride with you, and nobody likes a sloppy market, but they're a fact of life. And we just have to make sure that we're positioned well as things start to get better. I think right now there are no themes that I can identify that we are not focused in that are showing relative improvement. We watch it daily, and you'll hear about it from us if we do. But as it sits right now, it's sort of steady as she goes, and try and take some of the noise out, pull the lens back, look at a bigger picture. That's what we're doing, and we'll take this step by step. So thanks everyone for tuning in. Hopefully it's useful, and we look forward to seeing you again next week at 4 o'clock on Tuesday. Thanks, Pamela.
Thanks, Dave.